Central banks are among the most influential institutions in the modern world, yet they are also among the least questioned. They do not stand on the front lines of politics. They do not speak at election rallies. Yet the decisions they make directly shape the economic fate of nearly every individual. Central banks determine the price of money. They control interest rates, credit conditions, liquidity, and indirectly, the distribution of wealth within society. In other words, they shape not only the economy, but economic behavior itself. They can inject trillions into financial markets overnight. With the same speed, they can erode the real value of savings accumulated over years. And while doing all this, they are often not subject to direct democratic oversight. This video is the story of how central banks came to occupy this position. But this is not the story of neutral technocrats, as it is often presented. It is the story of institutions that became founding actors of the modern financial system. And once you understand this story, your relationship with money changes permanently. The origins of modern central banking are generally traced back to the year 1694. England had emerged from a long and costly war with France and was facing a severe financial crisis. State revenues were insufficient, borrowing capacity was limited, and the treasury was nearly empty. In this environment, a group of wealthy merchants presented the government with an offer. They would lend the state £1.2 million in exchange for the right to establish a private bank. The privilege granted to this bank was critical: the authority to issue paper money backed by government debt. Thus, the Bank of England was established. This institution was not a public bank in the modern sense. It was not created to protect citizen savings. Its primary function was to finance the state and generate income from that financing. Here, an important truth becomes clear. Modern central banks were not originally designed to ensure economic stability, but to finance war and state debt. The system proved successful. The state gained regular access to credit, and the bank secured a privileged position. By the 19th century, this model had spread across Europe. Central banks held the authority to issue currency, controlled reserves, and sustained governments during times of crisis. However, this power was not granted through democratic processes. Central banks held public authority, yet most were based on private ownership structures. Power was expanding. Oversight was not keeping pace. The United States remained distant from this model for a long time. There was a deep historical distrust of centralized financial power. The first and second banks of the United States were shut down amid accusations of elite control and corruption. Throughout the 19th century, the U.S. operated without a central bank. The cost was severe. Privately issued currencies, recurring financial panics, and violent economic crises followed. The Panic of 1907 nearly collapsed the entire system. The crisis was stopped not by the government, but by a private financier, J.P. Morgan. This event strengthened the belief that a centralized monetary authority had become unavoidable. In 1913, the Federal Reserve System was established. The Federal Reserve has a unique structure. It is officially independent, but not fully public. Its board is politically appointed. Its member banks are private. It is funded not by taxes, but by its own revenues. This structure gives the Fed extraordinary flexibility, and during crises, that flexibility reveals its true power. During the 2008 global financial crisis, the Fed did more than cut interest rates. It created trillions of dollars. It rescued banks. It supported asset prices. In 2020, the same policies returned on an even larger scale. Financial markets recovered rapidly. Asset prices surged. Wealth holders benefited. At the same time, millions lost their jobs. Small businesses collapsed. Income inequality deepened. Here, a critical distinction emerges. Central banks did not save the economy. They saved the financial system. Central banks do not merely implement monetary policy. They produce social outcomes. Interest rate cuts enrich asset holders. Rate hikes burden borrowers. Monetary expansion punishes savers. And all of this is presented under the banner of stability. Yet more often than not, the stability being protected is not that of individuals, but of the system. This is why the issue matters. When the cost of money is distorted, risk is mispriced, saving loses its meaning, and long-term planning becomes difficult. Most people never understand why this happens. Yet from loan interest rates to housing prices, everything is downstream from decisions made by central banks. Central banks are not gods, but they are not ordinary bureaucratic institutions either. They are active architects of the modern financial order. You cannot change this system alone, but you can understand it. And once you do, you can begin to protect yourself from its consequences. Because history shows one thing clearly. When the next crisis arrives, central banks will once again protect the system. Protecting yourself begins with knowledge,